So I'd love to now turn it over to Doug Coward, who is the executive director of the Solar and Energy Loan Fund out of Florida. We're really lucky to have Doug on the line. He's got over 3 decades of experience in Florida. He's an environmental planner, clean energy policy expert, and he was actually the commissioner of St. Lucie County in Florida for 12 years. So he really understands what it means to look at these problems from through a local lens. But now he's the founder and the co-creator of the Solar and Energy Loan Fund, or SELF, in Florida, which has received a number of awards, including the most outstanding green elected official from the U.S. Green Building Council. So without further ado, I'll turn it over to you, Doug, to talk a little bit about the SELF story and how it might be relevant to anyone in Virginia thinking about creating a green bank there.
Right. Thank you, Abe, and good morning to everyone. It's an honor to join you today for this discussion about creating green banks and to have a few minutes to share our experience creating what I believe to be the first local government green bank in America back in 2010. Our journey started about a decade ago, and as was noted, we were one of the folks who received a grant through the highly competitive DOE grant EECBG program. And it was basically a program trying to kickstart the development of local clean energy financing programs. And our Green Community Development Financial Institution Model, or CDFI, was selected as one such our program to test in St. Lucie County, with the long-term goal of becoming certified as a CDFI and then scaling the program, and most importantly, trying to achieve organizational sustainability. Not just promoting sustainability, but trying to actually sustain the organization. So nearly everyone thought that SELF would dissolve after the DOE grant expired in 2013. But what we found is that the demand for our products and services has literally been off the charts. And I'm super proud and excited to share with you that SELF has grown by 393% in our loan activity over the last 3 years. And we've opened up new satellite offices in St. Petersburg, Tampa, and Orlando so far. And we're currently working on expanding into Miami and the city of Atlanta right now. To date, we've financed about 2,000 sustainable home improvement projects in 90 jurisdictions in Florida, with a handful of projects in Alabama, Georgia, and South Carolina, the totaling about 18 million. Our average loan size is about 8,500, and our default rates have been below 2% over the last 3 years. So we're trying to do this prudently as well. And as a mission-driven lender, SELF is particularly pleased to report that 74% of our lending activity has actually been in low and moderate income communities where these programs are needed the most. 50% for women, 40% for seniors, and we've even developed special programs for disabled homeowners and frontline workers. So obviously we've only got a couple of minutes here today to share information about how we created SELF. So I'm really going to try and focus on just a couple of really high level thoughts that came to my mind. This exercise caused me to look in the rearview mirror and kind of reflect on some of the biggest challenges we had. But one of the things that jumped out at me is first and foremost is really the choice of the design and structure of the green bank. And there's, as been noted throughout this webinar, there's a lot of different choices and models to consider. And depending on your local landscape and politics, the answer may be different in one jurisdiction than another. But the fundamental question I would ask is whether your local government wants to become a bank or an investor, which in our case, we chose not to pursue that and put taxpayer money at risk. Choice B would be to create a nonprofit like SELF to oversee and administer the green bank. And a third option is to set up like public-private partnerships and apply more of a hands-off approach, which you typically see with the for-profit PACE companies. And we ultimately decided to choose the nonprofit route. And what the county did after getting the ARA grant from DOE was to actually create the nonprofit self-organization and spin it off into becoming its own independent organization with its own board of directors, staff, and budgeting And actually, by CDFI rules, local governments cannot actually have a control, be able to control those organizations. But what that does is really allow the nonprofit organization to do all of the work for the local government and to also take all the risks. So SELF has created more than a half a dozen lending programs. We've raised $30 million of loan capital and grants, and we even underwrite and service all the loans. So SELF has contributed a total of St. Lucie County has contributed a total of $75,000 to SELF over the last 10 years. And we've leveraged that into $8 million of projects in St. Lucie County alone. It's about 100 to 1 leveraging ratio. And I personally have about 20 years of experience working in local government, both as a senior environmental planner and 12 years as a county commissioner. And I have very high regard for local governments and the services that we provide. But local governments are not necessarily well suited for banking, and we've also seen a lot of abuses with the hands-off approach with these for-profit PACE companies. So my recommendation to you would be to pursue a nonprofit organization that can oversee the programs, they can ensure quality controls. Very important is to safeguard consumer protections, and then also to be able to leverage huge outside resources and expertise. As a CDFI, we're eligible for CDFI funding each year. There was just a separate rapid response grant put out by the National CDFI program, $1.25 billion. We work with the Opportunity Finance Network, OFN, and they've just rolled out a new $1 billion financial justice fund in partnership with Twitter. So there's all kinds of outside resources and expertise that you're able to bring in to help your local community. The second thing that jumped out at me is really the need to define your target market. Who are you trying to develop these lending programs for? Is it for residential, commercial, landlords, low and moderate income homeowners, all of the above? And a related question is, what are the typical types of size, project, and costs that you'll be financing? Are you intending to finance, $5,000 air conditioning systems or $10 million solar farms? And the answer to those questions are really going to help you determine which of the different types of financing programs out there are best suited, for that specific purpose. And I guess an overarching statement that I would make is that there really is not a silver bullet in terms of a one program fits all type opportunity. It's really best to create what I would describe as a broad suite of lending programs and to make sure not to forget low and moderate income communities. I think the clean energy economy has been quite successful across the country, but low and moderate income property owners are the ones most affected by climate change, and they're the ones who have participated and benefited the least from the clean energy economy. So I put a strong emphasis on making sure that you create a comprehensive approach that also includes LMI communities. For example, in St. Lucie County, SELF has created more than a half a dozen different types of lending programs. Our flagship program is our CDFI loans, but we also do Kiva crowdfunded loans. We do HALO loans for people with disabilities. We've set up special septic to sewer conversion loans with some of our local government partners and utilities. We've set up a residential PACE program and actually adopted higher consumer protections than are required by law. We've set up commercial PACE. We've set up PACE for new construction, and we're currently working on developing an entirely new lending product specifically for landlords in high energy burden communities. So you want to create a variety of different programs to try and help meet the different sectors in the community that you're trying to assist with. And then just lastly, I think one of the things that a lot of organizations don't put enough emphasis on is looking at how you're going to sustain the organization once you get it started. You're not only going to need seed funding upfront for administrative costs and some loan capital to get going, but you need to set up a business plan and a strategy for sustaining the organization long term. Are you planning to have the local government subsidize the green bank in perpetuity? Or can you structure these new green banks to generate sufficient earned revenue to cover all or a portion of their costs? For example, Self has actually developed what I would describe as modest fees and a spread on the loans to generate revenue, which is used to offset the majority of our operating costs. So for every $1 million of lending that we do, we generate about $50,000 to offset administrative costs. And in July of last year, Self broke our all-time monthly lending record. We did about $750,000 of loans in 1 month. And that was the first month in our 10-year history where we covered 100% of our operating costs from our lending activity. So that strategy is absolutely critical to sustain this your new green bank long term. And I believe this is going to be one of your biggest challenges. And it's also why Self worked so hard to scale and diversify our program so that we could reach the economies of scale that are needed to sustain these lending programs. And having looked at the Virginia legislation and the discussion about developing, individual green banks, I do have to say that I think it's going to be especially difficult to try and create a number of small individual green banks that are all trying to reach a scale to be sustainable. I think that's going to be really difficult. And I think it may be best for local governments in Virginia to explore some type of a regional or statewide partnership. Maybe there can be the creation of a nonprofit entity that multiple local governments could seed, participate, and benefit from. So those are just a couple of high-level topics that came to my mind as I think you're going to be grappling with the creation of green banks. And I'm certainly going to be on the call if there's any additional questions that you may have. So thanks again for having me today.
Wow, thanks so much, Doug. That was super relevant, and I found that really interesting. So thank you for sharing that with everyone. So we've got about 20 minutes left, and I do want to give us some time for a good Q&A. So before we dive into that, I just wanted to share a couple resources that are available to you all as you maybe kind of like thinking about this a little more. The first would be the annual industry report for the American Green Bank Consortium, which does a good job of kind of like laying out in writing the kind of green bank landscape, all the different green banks operating across the country and what they're doing. The second is a white paper that CGC wrote on kind of catalyzing investment for environmental justice, which I think is a really important topic when we think about like Doug said, the communities that you want to be serving with your green bank. And the last is just an overview of the federal efforts for the Clean Energy and Sustainability Accelerator. Please feel free to reach out to CGC or to any of the panelists if you have questions or want more resources on green banks. We at CGC at least definitely will talk to you ad nauseum about green banks generally. So without any other delays, let's move into the Q&A. I do need to pull that up. And thank you, all of you. Looks like we've got a bunch of good questions. Carrie, you want to say something?
Yeah, I've been monitoring the questions. There are lots of really excellent questions coming in, and I just wanted to verbalize that we will be following up with individuals after the fact if we're not able to answer all the questions, and I don't think we will be able to get to all of them. But I thought I would just start with one question to Doug, and others can chime in sort of on that last point around that balance between the small green banks in localities across the state and how can you properly capitalize and launch an initial green bank, for example, for a small community. The individual says probably 2/3 of Virginia jurisdictions have less than 60,000 people. So how can small localities or more rural communities or communities that don't necessarily have the capital at their disposal create at least the structure or the shell to invite external capital and ensure that those communities can benefit? And I'll just invite anyone to jump in, Doug or others.
Well, on the topic of capital, I mean, one of the things that was critically important when the DOE grant provided was first 3 years of admin dollars, but it also gave us about $1.5 million to establish the original revolving loan fund. And when you're setting up these green banks and don't have an established track record, one of the challenges you'll have is raising new loan capital. You know, in our first couple of years, if we closed $100,000 or $200,000 loan investments, we were super excited. Now, 10 years later, we just closed a $5 million line of credit with Bank United. And candidly, we're actually turning loan capital away because we don't have the organizational capacity to deploy it. That's one of our biggest challenges in expansion, is that we don't have venture capital to actually grow these programs. So we typically partner with local governments who seed the programs, and then we can use that seed grant to actually leverage outside capital, typically around 10 to 1, and then bring those resources into the community. But one of the reasons we chose the CDFI model was because of its ability to raise low-cost capital from a variety of sources. We've now raised about 30 million, and we're raising money from faith-based organizations, health organizations, bank CRA investments, global crowdfunding, impact investors, the OFN Financial Justice Fund, the CDFI Fund has annual awards. So there are numerous ways that a CDFI can raise funds. There are other models, but that's the reason why we chose the CDFI model. And also the cost of capital. If you're able, as a nonprofit lender, we're able to raise low cost capital, which then enables us to put a spread on that loan and still put those loans on the streets at below market rate. But it does provide us the ability to not only raise the capital, but generate some earned revenue through our lending activity as well.
Yeah, and I would just tag on to that when it comes to kind of smaller or rural counties. One of the pieces of the federal legislation as envisioned is for the Green Bank to not only provide capitalization to new funds, but also to provide technical assistance to help with that kind of scaling up of activity, so that, you know, there wouldn't be communities left behind just because they don't have that kind of initial operating capital to help set up the fund. There would be, you know, federal dollars available to help with the hiring of staff, with the creation of the institution itself.
And I'm sorry, can I just add a little point to that? I had some experience with CPACE in various jurisdictions, and it's not the same thing, but there might be a lesson to be learned there. A few counties were early adopters of CPACE, like Arlington, and other counties wanted to implement the program, but they weren't sure if they wanted to make the investment or if they had the support. So what they did was they were able to use the Arlington program as a way to sort of pilot test it, and then once they saw how the process worked, they went about the process of implementing their own local programs. That happened here in Fredericksburg, where I live, where we financed the baseball stadium using CPACE. So we might want to look at whether or not Fairfax is in the front right now in the lead. If there's a way that other jurisdictions can maybe partner with and learn through the Fairfax model as they envision sort of building their own.
Yeah, I'm sorry that Delegate Corey is not still on the call, because yesterday during our prep call, she did say that she's already thinking about follow-on legislation, in which way they can further authorize, for example, DMME or other organizations within state government to help smaller counties to perhaps group together and access some of the expertise and funding that's going to be necessary.
Great. Yeah, and I just want to emphasize the importance of taking those early steps, the enabling ordinance, and moving forward such that at least the initial structure is open to receive those federal dollars when and if they might become available, and other technical assistance. There's another couple of questions that are around the key distinction between a green bank and a traditional bank. So it may be a little bit confusing to people, and thought I would ask, where are the boundaries? Obviously, they have to go towards clean energy technology in terms of the types of funding. But are there other regulations that might apply to a regular bank that do not apply to this type of entity?
Yeah, so that's a great question, and it's one that we get a lot. Green banks are titled such as a term of art. Um, they are not, generally speaking, depository holding institutions, and they function much more like a specialized investment fund than your kind of brick and mortar bank that you may be familiar with. Um, and because of that, we've seen a lot of new green banks being called things like, Clean Energy Fund, Clean Energy Corporation, like SELF is the Solar Energy Loan Fund, and the term green bank, which really comes from the world's first green bank, which was in the United Kingdom as the Green Investment Bank. Um, in the U.S., we've named most of ours kind of fund or corporation to kind of get around that distinction. Um, I'll talk a little bit also to the question of like what is in and out of scope for green banks. And green banks really focus on kind of accelerating and expanding deployment of kind of proven available technologies. What they don't often address is serious technology risk. So if there are kind of like new technologies coming into the market that people are having like a lot of difficulty financing, it's very rare that green banks have been able to kind of like come in and address a lot of that technology risk. What they have been able to do is work with kind of existing technologies that are already proven, that are in the market, that should be accessible to everyone, and expand the access of financing so that there's more of those projects being developed, especially to communities that haven't traditionally been able to kind of benefit from that technology.
Okay, great. And there's another question around complementary financing. So can you give examples of how green bank financing can complement traditional financing or maybe other types of financing? This person is asking about a regular solar customer, maybe a residential solar system. And that same question is also asking, is green bank financing really meant for these large commercial projects or community solar, or can it scale down to individual residential household projects?
Yeah, so I'm sure Doug has like amazing specific examples of this kind of activity, and maybe I'll let him talk to that in a second. But I will speak broadly to this idea, and I think green banks have been able to operate across the space. It really depends on one, your capitalization, and two, your focus market. So in New York, they created a statewide green bank with $1 billion of investment. They focus on kind of large transactions, big companies, kind of market-changing technologies. The governor in New York really wants to focus on offshore wind, really has ambitious storage goals. New York Green Bank is there to fulfill the kind of brain damage and financing side of that. Conversely, in Connecticut, the Green Bank had a strong mandate to focus on kind of small commercial, residential solar, and so they worked with a network of private lenders to offer a loan loss reserve, a form of credit enhancement, to encourage those lenders to invest and provide debt to kind of residential solar projects. So by offering the loan loss reserve, offering co-investment strategies, kind of coming in as a subordinate lender to kind of de-risk the transaction for private investors. Green banks are able to kind of really play a role where they partner with private lenders and encourage them to jump into the space. But like I said in the beginning, when it comes to the types of projects, it really depends on the target market and the size of the green bank, the geography, and what you're focused on. And maybe Doug, I don't know if you want to talk a little bit about like how that worked in Florida for St. Lucie and SELF, but that could be relevant.
Sure. And I would note that 80% of all of our projects actually come in from our contractors. And why I bring this up is because contractors tell us that they basically have to walk away from 20 to 40% of their business because homeowners and property owners cannot qualify for traditional financing. So these green banks are filling that void, particularly the CDFIs that are working in underserved communities. So let me give you a specific example. We had a retiree who applied for a $10,000 loan and he had a 0 credit score. He would have no chance of getting approved by a traditional lender, but since we're like a small bank, hometown bank that gets to know our clients, we took a closer look at this gentleman's situation. You would think with a 0 credit score that he had defaulted on every loan in his life. The reality was that he owned his house, had no mortgage payment. He was retired, had retirement income, and had the ability to pay. He had not actually defaulted on a single loan in his entire life. What had happened is that he had not used traditional financing since 1994 and therefore had no credit score. So Self approved a $10,000 loan for this gentleman despite the fact that he had a 0 credit score. He's not only gaining access to capital and getting it at a very low rate, but we also report our loans to the credit bureau, which means that over the term of the loan, he's actually building his credit with us. If I can give just one other quick example, we had a contractor in Central Florida contact us and say, hey, we've got an elderly woman whose husband just passed and she had to declare bankruptcy due to medical bills. Her roof is falling in and she needs a $10,000 loan. Can you help us? We had just finalized our new partnership with Kiva, which is a global crowdfunding platform. And so we said, let us try. We put Verda, her profile, on Kiva's international crowdfunding platform. And to our absolute amazement, we raised $10,000 in 6.5 hours from 331 individuals on 3 different continents, and then brought that money from around the globe back into Florida and provided Verda, who had a 525 credit score, with a $10,000 loan at 5% interest fixed for an unsecured personal loan. Her daughter called me and said, are you trying to scam my mother? And we said, no, I can assure you, we're a nonprofit organization who is trying to help. So I often hear, and I won't get into politics, but from certain parties suggesting that the market will cover all these. There's no gap. We don't need these. Well, that's a bunch of hogwash. There are huge numbers of folks that fall into the unbanked and underbanked category who do not have access to traditional financing. And our Green Bank focuses on ability to pay rather than credit scores and equity. And therefore, we're able to fill the gap, help the homeowner, and also help those local green businesses grow and create more jobs.
I just want to echo what you said, Dan. That's actually that's similar to the experience of other green banks in our region. I talked to the folks at the Maryland Montgomery County Green Bank and the Washington D.C. Green Bank in preparation for our webinar, and they talk about the flexibility that this funding provides in terms of what is a credit-worthy off-taker or buyer. And they're using things like, I think Abe and Carrie may have alluded to, on-bill financing. Studies are showing that that people, before they stop paying their electric bill, they'll stop paying their cars. They'll cut back on almost every other bill they have besides their electric bill, because we're a digitized society, and they value that significantly. So that's becoming part of a sort of an innovative way that people are looking at whether a person is able to afford and financeable for these clean energy and clean tech projects, as opposed to just going by traditional FICO scores. So I think you're going to see a lot more of that type of financial innovation as we move forward and deploy green bank, green fund initiatives here in Virginia, hopefully, and open the market to a lot of communities. We have quite a large underserved community in the Commonwealth of Virginia, both in the west part of our state, down in the Tidewater, in some of our metro areas, and those folks are right now not part of this equation. They need to be part of it.
Thank you very much, Walter, for that. I'm watching the time, and I know Abe's going to want to wrap up here in a minute, but I thought I would address one other question that has come up pretty frequently around the intersection between commercial property assessed clean energy, CPACE, and green banks. And I actually reached out to Abigail Johnson, who's the president of Virginia PACE, in advance to get her answer on this. And so I'm just going to read what Abby wrote me yesterday. And I know Abby's on the call too, so hopefully I do her justice here. She said the Montgomery County, Maryland has a green bank, and DC has a green bank. PACE financing is part of that in both cases, but to note that the PACE program runs separately. And she says that one way a green bank and PACE can work more directly together is to guarantee or provide loan loss reserves or interest rate buy downs. And Abe mentioned this as well, as a supplement for PACE and for smaller deals. And just want to thank Abby. And I think, you know, we're going to be seeing more detailed questions come in about this structure, and probably we'll be hosting other webinars in the future. As I mentioned, we're going to try to get back to everyone on these questions within the next week. So we'll facilitate that amongst our panelists. And I'll just, with that, thank everyone for their attendance and hand it back over to Abe.
Yeah, no, thanks, Carrie. And thank you to everyone for taking the time to join us today. I hope that this was informative. And if you have more questions, like Carrie said, we're going to try to follow up individually for those of you that didn't get your questions answered during the time that we had. But if you do have further questions, feel free to reach out to me or to any of our speakers. We will be sharing the recording of this webinar and our contact information here so that you can do so. So with that, thank you very much for joining the webinar today, and I hope you all have a great rest of your Wednesday.
Thank you, everyone.
Thank you.
Thanks, everyone.